Good afternoon, class. I first of all must apologize for not being able to have our regularly scheduled class today. I am marshalling the BSc Accounting students for graduation Friday, and today is rehearsal at 4. I've been to these rehearsals before, and sometimes they take as long as 3-4 hours to do. So today I wanted to just quickly use this hour to introduce you to the topic. And when we regroup on Thursday, then we will work a question and again on Saturday. It means, therefore, that this week we'll be wrapping up our variance topics. Now, the following week we'll go into the final chapter, but the Saturday of next week or the following week, you all need to decide which Saturday you want to meet to do your variance project. Now, with the variance project, what's going to be happening is that you'll be put in groups of 4. I will send out a schedule and you select from the schedule what times you want to meet to do your project. You know what, in fact, I think I'm going to leave it for the last week in the semester. Why I say that is that it will give you options. You can either do it the 1 hour on a Wednesday, 2 groups can meet on the Thursday, and 3 groups can meet on the Friday. And I think that should be sufficient to cover everybody. So I think I'm going to take the decision here and just give you that exam on that last week. Because what it means is that you won't know which variance topic is coming. You won't know. So you have to prepare for all of them as a group, which would mean that you have to get questions from the different topics, practice them, discuss them together, make sure you understand what it is all about, so that whatever question I give you, you would have had discussions around it already. Not necessarily that question, but I've had discussions around the topics already. And so you should be able to finish up within the hour. Because you're going to be given an hour, you have to take 45 minutes to read the question and do the question, and then it must be handed to me at the end of the hour as an upload. Okay? But I'll discuss that later on in the week. But the essential thing to note is that it's going to be the final week of the term. The other thing to note is that you have to find 3 persons in your group and link with them to do the test. I've already spoken to Nikisha about how we're going to deal with her situation. But for the rest of you, you have to be in groups of 4. Okay? So on the day of the exam, I'll tell you which question you're getting, whether it's a mix and yield, whether you have to build an operating statement, which means using your basic variances, whether it means you're going to be using planning and operation variances, which is our topic for today. Now, variances have an impact on your psyche. Ask anybody who is paid through a sales commission, where their compensation is based on their output. So let's say, for example, somebody works in a bank. How many credit cards did they sell for the month, and what was the value on it? So their target could be to sell sufficient credit cards to the tune of $100 million. Sorry, 100, that sounds small, to $500,000. That's their budget target for the month for credit cards. Now, if they are consistently earning that, it means at the end of the year, they're going to get a bonus. Or every quarter, they get paid their commission. Now, here's the psychological side of budgeting, or the behavioral aspect of standard costing and, by extension, budgeting. If the person feels that these targets are unattainable, it is not going to be a motivator for them to work. If management feels that these targets are too easy, then it's going to affect their pockets, because the people are going to do too well, and so they're going to pay out too much money. So they have to strike. There has to be a middle ground that has to be struck between management and those persons who are compensated based on their performance, based on their output. So a target can either affect you psychologically by motivating you, or acting as a deterrent or a demotivation. Now we're going to be looking at planning and operational variances, which is the final of the set of variances in this topic. And when a standard has been set, it is the base on which actual performance is measured. So what we have been doing since the start of these topics on variances is that we have been looking at an actual measure, whether it be weight or a mix of products, an actual measure and a standard measure. Now, out of that assessment, we can have adverse variances and favorable variances. So in the case of expenses, if the actual payout is less than the budget or the standard, then our variance is favorable. But for income, if the earnings is less than anticipated via the budget, then the variance is adverse. So depending on income or whether it is an expense, you have to appreciate how to determine whether it is an adverse variance or a favorable variance. But these variances that we've been working on to date have been on the assumption that they have been accurate throughout the year, and the operational environment for the company has been stable. So no shocks, no surprises. But that is not the reality. And so what happens is that the budget that one would have spent months crafting before the financial year begins, things can happen. Things can happen that causes these budgets to no longer be realistic. Now, let us look at a restaurant, somebody who owns a restaurant, who at the start of the year had budgeted that a 2-pound chicken, for example, would be costing on average $1,000 for a 2-pound chicken. Now, they would have gone and done their costing, made their plans, and gone out at the start of the financial year to do their business, to run their operations. Now, the price of chicken has gone through the roof at this point in time, and Christmas is yet to come, where prices normally increase generally. What it means, therefore, is that the budget that they had crafted at the beginning of the year, which was reasonable, now makes no sense. There's no way you can buy a 2-pound chicken for $1,000 now. Not possible. What it means, therefore, is that any actual spend or any actual income that surrounds that chicken price, you cannot compare it to the budget you had from the start of the year. It's not going to be fair, because let us say that the chicken was an expenditure related budget. You have now been spending twice the cost for chicken. It means that you're going to be automatically generating adverse variances. And these adverse variances are not of your doing. Because the whole idea of a variance is to find out first and foremost why it happened. What was the reason for this adverse or favorable variance? The second point is to know how to deal with it. But the third point is who is responsible for managing this variance. So if you were the procurement manager and you're the guy or the female who has been spending and buying these expensive chickens are not your fault. It is purely economics. And so the variance, the expenditure variances that are now being adverse because of the rising price of chicken, you cannot be held accountable for that because it is out of your control. So likewise, on the flip side, Best Fresh Chicken and CB Chicken may be experiencing some great price variation, selling price variations, because the price of chicken has just been going up, 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 up. Now, the sales manager cannot be held responsible for that or be accountable for that, because yes, it looks good on him because the sales price variations have gone up and to an extent has impacted revenue favorably. But there's a downside, because the increased prices in chicken, the increase in the chicken prices has a balancing effect that less people are buying them. So the sales manager, on one side, his variances are going to look good. On the other side, his variances are going to look very poor, which is the sales volume variances, because he's selling less. But again, he cannot be held accountable for these things. So therefore, the purpose of planning on operational variances is to ensure that whoever the manager is fairly assessed in terms of the variances, because you break up these variances into the parts where he or she has control, and another part, the variances are broken up into parts where he or she has no control and therefore cannot be held accountable. So the operational, if you have a variance and you split it into operational and planning, essentially the manager is accountable for the operational variance, but he is not held accountable for the planning variance, because this planning variance experience changes outside of the control of the manager. And so I have set the stage now for the topic that planning and operational variances have been computed so that the manager responsible can be fairly assessed coming out of a variance analysis, fairly assessed in those situations where there has been a shock in prices or an unexpected change in some parts of the production process. Okay? So we're going to go into, I'm going to quickly walk through the text with you so that when we meet tomorrow to work the question, I can assume that you have watched this video and that you are able to follow me as I go along and understand the rationale as to why these variances have to be calculated. So let me read this highlighted block here. It says a planning and operational approach to variance analysis divides the total variances into those variances which have arisen because of inaccurate planning or faulty standards, and those variances which have been caused by adverse or favorable operational performance compared with a standard which has been revised in hindsight. And this is the operational variance. So the key thing to extract from this is that there is a revised budget. So in our calculations for planning and operational variances, a new budget has to be indicated. And this new budget becomes the new standard against which we're going to measure the old standard and our new activities. All right? So let's hold that thought for now, and let us go into the specifics. Now let's look at the key terms, and then we're going to go through the text quickly to cover this 1 hour session. Now it says a planning variance or revision variance compares an older original standard with a revised or new standard that should or would have been used if the planners had known in advance what was going to happen. So back to my chicken situation. If the planners knew that the price of chicken was going to skyrocket, then they would have known that they would have had to change the old budget to facilitate this. But they could not see into the future. And so they were caught unawares. It therefore meant that a new standard, a revised standard, would have to be created. Now, an operational variance will then be comparing the actual result with the revised standard and not the old, outdated standard. So, hold that thought. So we're going to move now into calculating total and operational variances. Now here's the thing. These planning variances are extensions of the variances that we have already encountered. Let me see if I can show you what I mean. We can create planning and operational variances for raw material. We can create planning and operational variances for labor. So if we had a material price variance and a material usage variance, those two variances can be split. Each of them can be split into operational planning and planning variances. So we can have a material price planning variance and a material price operational variance. We can have a material usage planning variance and a material usage operational variance. We can have a labor rate planning variance and a labor rate operational variance, which is coming from the labor rate variance itself, broken into two. And likewise, the labor efficiency variance that we have already discussed, which looks at how the persons have worked in terms of total hours to make that output, the hours that they have worked compared to the hours they should have worked. This is the labor efficiency variance. We can break that down into two subvariances, a labor efficiency planning variance and the labor efficiency operational variance. So these additional variances will have to be calculated if something unexpected comes up that is going to make the comparison of the old variance with the actuals totally unreasonable or unrealistic. Okay, so now let us explore example 1.1.1. Now the question continues by saying that at the beginning of the period, this company had set a standard cost of $25 per unit. $25 per unit. Now, during the period or during the actual production in August, they spent $304,000 when 8,000 units were made. So let us look at this first section. They spent $304,000. Okay? But the budget or the standard that they had set was $25 on each unit. So if we were to calculate the normal variance, we'd have taken the $8,000, 8,000 units, and multiplied by 25 to see what the expected or budgeted production cost would be. And I'm going to jump to this part of the solution and look at it. It says if traditional variance analysis had been used, the total cost variance would have been, let's look at it, the actual cost of 8,000 units, $304,000. But if we took these 8,000 units and multiplied by the original standard, we'd have had $200,000. So what it means, therefore, is that they have overspent and generated this adverse variance of $104,000. Now, therefore, in the normal scheme of things, management would have had to inquire and say, why is this variance so significant? Why is it adverse in the first instance? And notice how they have highlighted the word blame, because every cost and every variance has to be accountable or be responsible, the responsibility of somebody. So somebody would have to explain why the variance is the way it is. Remember, I had said earlier that sometimes things happen. You set a budget, and midway through the budget, the period, or at the beginning of the period, something happens that was unplanned, they did not expect. It could have been a world shock in a price, whatever. So whichever manager this is, who would be explaining why the $104,000 variance, adverse variance on top of it, exists, you cannot blame him or her for some elements of this variance, because the original standard of the $200,000 is no longer relevant, because we just read that the original variance standard, the original standard was $25. Now let's continue the question. It says, with the benefit of hindsight, this is where we are. With the benefit of hindsight, the management realizes that a more realistic standard would be $40. $25 compared to $40. So they realize that the 25 is low. So this $104,000 here, we have to break down this variance into two: a planning variance and an operational variance. So let's look at the operational variance. With the operational variance, you are comparing the traditional cost, the actual cost, You're comparing the actual cost with the revised standard. You're comparing the actual cost with the revised standard, and that is the operational variance. With the planning variance, you're comparing the original standard with the revised standard. So the manager really should only be responsible to explain this variance here. Let's see how they calculate this $16,000 favorable. So with the operational variance, it's the actual cost of the $304,000. But the standard against which it is measured is the new standard. So those same 8,000 units will now be multiplied by $40 and not the original $25. So that brings our total revised standard cost to $320,000. So now we're comparing our actual cost with a more realistic standard, and by extension, a more realistic budget figure. So in this instance now we see where the manager is actually saving the organization money because the actual cost works out to be less than the revised figure of $320,000. So now we have a complete switch coming from 104,000 adverse to 16,000 favorable. But what about the rest of the breakdown? So the planning variance is now calculated using the original standard of 8,000 times 25, comparing it now with 8,000 multiplied by 40. And we have ourselves ending up with an adverse variance of 120,000 adverse. It shows you here that because of the revision of the standard, it now moves that old standard to a larger cost of $320,000. And so the planning variance, that element of the original variance, amounts to 120,000 adverse. Now when you add both, now look at this. When you add the planning variance, which is adverse, to the operational variance, which is favorable, then you find that the overall position is $104,000 adverse, which was the original variance we came up with using the old standard. So now we cannot blame the manager on the 104, which now splits into a 120 adverse and a 16 favorable. The manager is now only accountable for the $16,000 favorable variance. Now, here's a little homework for you to do before class. Suppose a budget is prepared which includes a raw material cost of $2, which is 2 kilograms at $1. All right? So this is the standard. They plan to use 2 kilograms of raw material at $1 each for each unit of product. Now, due to a rise in the world prices of copper during the year, the average market price of copper rises to $1.50. So they originally had $1 per kilogram for the copper. It now increased to $1.50, which they did not anticipate. So during the year, 1,000 units of product produced a cost of $3,250 for 2,200 kilograms of copper. Now, we know that the price, the actual price, was $3,250. All right. Now, we do not know we'll have to work out what the original price was supposed to be for these 1,000 units. Okay. So it's 1,000 units times $2. That was the original plan. 1,000 units times $2. But no, we cannot use, that's the original price. Now, we can therefore now break out the variance into planning and operational. So let's see what you can do with it for our class this evening. So just go back and rewatch what we just went through and see what planning and operational variances. Now I want to see if we have planning and operational variances for price, material price variances. Remember I said that a material price variance can be split into two. And notice I said earlier in the discussion that a material usage variance can be split into two. Now, let's see here. We have 2 kilograms at $1. So that's $2. So it's $1.50 per kilogram. So I don't think that there's going to be a shift in the usage of the raw material. I think the implication here might be a shift. Ah, yes, look. If they are making 1,000 units, it's $2, 2 kilograms per unit. If they are making 1,000 units, it's 2 kilograms per unit. But look how many kilograms they use. 2,200 kilograms. So you'll have to compute a material usage variance. But then I think the emphasis though is going to be on the price, because of the shift of the standard from $1 to $1.50 per kilogram. So looking at the actual kilogram used of 2,200, we're going to see where there's a price shift. So find out what that price shift is under the revised price. But you work through it and see if you can come up with the planning variance for the price and the operational variance for the price. And remember, the planning matches the original standard and the revised, and the operational variance is computed by looking at the actual price and the revised standard. Okay? All right, so I'll see you later. I should have dropped this recording yesterday, but time got the better of me. It is now 5:45, so I'm putting it in the Moodle, Moodle by about in another 10 minutes. So I'm hoping, well, the fact you're listening to me now means that you have finished watching this video. All right, I will see